If the war in Iran escalates, it could move every financial market on earth. Oil prices could jump overnight, stock markets could swing wildly, currencies could surge or collapse, and investors everywhere could suddenly change how they allocate money. What happens in one region of the world can ripple across the entire global financial system, and right now the Iran conflict is one of the biggest forces shaping financial markets. Most people think wars only affect the countries involved, but in reality, modern financial markets react instantly to geopolitical conflict. The moment investors believe that global stability is at risk, prices begin to move. Oil rises, stocks become volatile, safe haven assets attract capital, and uncertainty spreads across markets. And Iran matters more than most places on earth. That is because Iran sits next to one of the most important oil shipping routes in the world, the Strait of Hormuz. A huge share of the world's oil supply passes through this narrow stretch of water every single day. When markets believe that this route could be disrupted, oil prices react almost immediately. That is why traders everywhere watch this region so closely, because when oil moves, everything else follows. And this is the part many investors misunderstand. Wars do not affect financial markets randomly. There is actually a clear chain reaction that explains almost everything that happens. It usually starts with oil. When conflict increases in the Middle East, traders begin pricing in the possibility that oil supply could be disrupted. Even if nothing has actually happened yet, the risk alone is enough to push prices higher. Markets do not wait for a shortage. They move as soon as uncertainty appears. And when oil rises, the effects spread quickly through the global economy. Higher oil prices mean higher transportation costs. Businesses spend more moving goods around the world. Airlines pay more for fuel. Shipping becomes more expensive. Manufacturing costs rise. Eventually, those higher costs reach consumers. That is when inflation begins to move higher. So the chain reaction looks something like this. War increases uncertainty. Oil prices rise. Inflation increases. Central banks become more cautious. Interest rates stay higher for longer. Borrowing becomes more expensive. Economic growth slows, and financial markets adjust to this new reality. Once you understand that chain reaction, the behavior of financial markets during war starts to make much more sense. Oil really is the center of the story. Even small disruptions can move oil prices significantly because energy markets operate on tight margins. Supply and demand usually stay closely balanced. That means it does not take much uncertainty to push prices higher. And during geopolitical conflict, traders are not just reacting to actual supply losses, they are reacting to the possibility of supply losses. If markets believe that production facilities might be damaged, or shipping routes might be blocked, or insurance costs might rise, prices can jump quickly. Countries sometimes increase their strategic oil reserves during conflict periods. Investors also buy oil contracts as protection against geopolitical risk. These forces add even more upward pressure, so even without a real shortage, prices can rise sharply. And when oil prices rise, inflation usually follows. Energy is one of the most important inputs in the global economy. Almost every product depends on transportation or manufacturing processes that use energy. When energy costs rise, businesses face higher expenses. At first, companies try to absorb those costs, but eventually they pass them on to consumers through higher prices. Fuel costs rise first, then transportation costs increase, then manufacturing costs rise, and finally retail prices move higher. This process can take months, but markets start pricing it in almost immediately. and this creates a difficult situation for central banks. When inflation rises because of higher energy prices, policymakers face a dilemma. Cutting interest rates to support economic growth could allow inflation to rise further. Keeping interest rates high could slow the economy. This uncertainty often keeps financial conditions tighter for longer than investors expect. That environment usually puts pressure on stock markets. Stock markets typically fall during the early stages of war because uncertainty rises sharply. Investors dislike uncertainty more than almost anything else. When future economic conditions become less predictable, investors demand higher returns to compensate for risk. Higher required returns mean lower valuations. So stocks often decline initially, but something interesting happens after that first reaction. Once investors begin to understand the scale of the conflict, markets often stabilize. Sometimes they even recover. History shows that stock markets frequently bounce back after the initial shock of geopolitical events, but not all sectors behave the same way. Some industries actually benefit during wartime conditions. Energy companies often perform well because higher oil prices increase revenues and profits. Defense companies can benefit from rising military spending. Certain defensive sectors like utilities sometimes hold up better because demand for essential services remains stable. Other sectors tend to struggle. Airlines often face higher fuel costs, which reduce profitability. Transport companies face similar challenges. Consumer businesses can suffer if inflation reduces spending power. Technology stocks sometimes become more volatile because investors reduce exposure to growth-oriented assets when uncertainty rises. So the impact on stocks is not uniform. It depends heavily on the sector and the economic environment. Currencies also react quickly during geopolitical conflict. Foreign exchange markets reflect global capital flows. When investors become nervous, they move money toward countries and assets that appear stable and liquid. That usually means safe haven currencies strengthen. The US dollar often rises during periods of geopolitical stress because global finance depends heavily on dollar liquidity. When uncertainty increases, institutions often increase their dollar holdings. The Swiss franc tends to strengthen because Switzerland has a long history of financial stability. The Japanese yen often rises when investors unwind riskier investments and reduce borrowing in low-interest currencies. At the same time, currencies linked to global economic growth often weaken. The Australian dollar and New Zealand dollar tend to move with global growth expectations. When investors become cautious, these currencies often come under pressure. Emerging market currencies can weaken as investors move capital back toward developed economies. Oil prices also influence currency movements. Countries that export oil sometimes benefit when energy prices rise because higher export revenues strengthen their economies. Countries that import large amounts of oil may face pressure because higher energy costs worsen trade balances. So currency markets reflect both risk sentiment and energy dynamics. Bond markets react in their own way. Government bonds often rise during geopolitical crises because investors seek safety. Large institutions move capital into assets that offer stability and predictable returns. This demand pushes bond prices higher and yields lower in the short term. But over time, inflation pressures can change the picture. If higher oil prices push inflation upward, long-term interest rates may eventually rise. So bond markets often go through two phases. First comes the flight to safety, when yields fall. Then comes the inflation phase, when yields may rise again. Understanding that sequence helps explain why bond markets sometimes move in unexpected ways during geopolitical events. Safe haven assets play a crucial role in this environment. Gold often attracts strong demand during periods of geopolitical tension because it has historically been viewed as a store of value. Investors often turn to gold when uncertainty increases. Government bonds attract demand because they are considered among the safest financial assets. Safe haven currencies strengthen as global capital flows towards stability. These movements reflect a broader shift in investor behavior. When markets become uncertain, investors focus less on growth and more on preservation of capital. The short-term impact of geopolitical conflict is usually dominated by volatility. Markets move quickly as new information emerges. Headlines can trigger sudden price swings. Traders adjust positions rapidly as expectations change. Liquidity can become tighter as investors reduce risk exposure. This environment often produces sharp market movements in both directions, but the medium-term outlook depends mostly on energy prices. If oil prices remain elevated for an extended period, inflation pressures tend to persist. That can slow economic growth and keep interest rates higher for longer. Businesses may face higher costs and lower profit margins. Consumers may reduce spending. Economic growth can slow gradually. Financial markets adjust to this environment over time. The long-term effects depend on whether geopolitical tensions become permanent. Persistent instability can reshape global trade patterns and investment flows. Countries may diversify energy supply routes. Strategic reserves may increase. Defense spending often rises during prolonged periods of geopolitical tension. Supply chains may shift toward more stable regions. These structural changes can influence financial markets for years. Investors trying to understand the future direction of markets often watch a few key indicators. Oil prices remain the most important. Energy markets drive inflation expectations and economic forecasts. Shipping conditions are also critical because disruptions to major routes can influence supply expectations. Bond yields reflect inflation expectations and growth outlook. Gold prices indicate safe haven demand. Currency movements reflect global capital flows. Market volatility measures reflect uncertainty and investor sentiment. Together, these indicators provide a picture of how markets are reacting to geopolitical developments. Looking ahead, the most likely environment involves continued uncertainty with periodic volatility spikes. Energy prices are likely to remain the primary driver of financial conditions. Safe haven demand may remain elevated. Volatility may stay above normal levels. Economic growth could slow moderately if energy prices remain high. That combination creates a challenging environment for investors. Understanding the mechanisms behind market movements can make this environment much easier to navigate, because once you understand how war affects financial markets, the price movements start to make sense. The Iran conflict is not just a regional story, it is a global financial story that influences commodities, currencies, stocks, and bonds at the same time. And that is why traders and investors around the world pay such close attention to developments in this region. If you found this breakdown useful and want deeper insights into how global markets really work, make sure you like the video, share it with other traders and investors, and subscribe to the channel for more professional market analysis.